Why is $1 not the same as £1 or 1 yen? A dollar, a pound, and a yen are just pieces of paper or numbers on a screen. So why isn't $1 worth the same as £1 or 1 yuan? It seems random, but currency value isn't about the symbol. It's about what that money can actually buy and how much people trust the economy behind it. Every currency reflects the strength of its country. When an economy grows, produces goods, attracts investment, and stays stable, demand for its currency rises and its value increases. When it struggles with job losses, huge deficits, or excessive money printing without real backing, trust falls and the currency weakens. Exchange rates change constantly because economies are always shifting. A dollar might buy 100 yen today, but only 98 tomorrow. Trade also matters. If Japan sells more to America than America sells to Japan, demand for yen grows, pushing its value higher. Currencies compete in a global marketplace based on economic performance, trade balance, stability, and investor confidence. So a dollar doesn't equal a pound because America and Britain have different economies, different money supplies, different levels of global trust, and different futures. The number on the bill means nothing. What matters is the real economy standing behind it. Why is every country in debt? And who do they owe? They owe each other and their own citizens. Governments borrow by selling bonds, basically IOUs. You lend the government $1,000 today, and in 10 years, they pay you back with interest. Buyers include individuals, banks, pension funds, other countries, and investment firms. When America owes $36 trillion, part of it is owed to American savers, Chinese holders of treasury bonds, Japanese investors, and global institutions. Governments rarely pay off the full debt. They refinance by issuing new bonds to pay old ones. As long as the economy grows and people trust the country will keep paying interest, the system continues. National debt isn't like personal debt. You can't repossess a country. It only becomes dangerous when trust collapses and no one wants to lend anymore. Why can't governments just print more money? If a government needs cash, why not print it? The answer is simple. Printing money without real economic growth destroys value. Imagine a town with 100 people and 100 loaves of bread, each costing $10. If the government prints extra money and hands it out, people have more cash, but the same amount of bread. Everyone rushes to buy, prices rise, and your money buys less. That's inflation. Printing doesn't create wealth. It dilutes it. More money chasing the same goods drives prices up. In 1923 Germany, hyperinflation made a loaf of bread cost billions of marks. People needed wheelbarrows of cash just to shop. The money became worthless wallpaper. Governments can print money safely only if the economy grows alongside it, producing more goods and services. Without growth, extra bills just cause inflation and destroy trust. You can't print real wealth. You can only print inflation. What is Bitcoin? Bitcoin is digital money that exists only online. No physical coins, just code. Unlike dollars in your bank, no government or company controls it. It runs on blockchain, a public ledger recording every transaction. When you send Bitcoin, the transaction is verified by thousands of computers worldwide through complex math. Once confirmed, it's added to an unbreakable chain. Everyone can see it happened, but your identity stays hidden. The system is decentralized, so no one can freeze your account or print more Bitcoin. There will only ever be 21 million coins. Scarcity is coded in. That's why it's called digital gold. But Bitcoin has drawbacks. Transactions are slower than credit cards. Prices swing wildly. And if you lose your password, your money is gone forever with no recovery option. Bitcoin proves money can be created through math and code instead of government trust. Whether it becomes the future of finance or remains a speculative asset is still debated. What if inflation goes negative? Falling prices sound wonderful. Cheaper groceries, lower rent. But when inflation turns negative, deflation, the economy freezes. If you expect prices to drop next month, you delay buying. Businesses see fewer sales and cut prices further, creating a vicious cycle. Demand collapses, companies lose revenue, lay off workers, and unemployment rises. People spend even less, and prices fall harder. Debt becomes crushing. You still owe the same amount while your income shrinks. Defaults increase, banks struggle, and credit dries up. Japan's 1990s experience showed how deflation can stagnate an economy for decades. Inflation hurts, but deflation paralyzes. Economies need gentle price rises to stay alive. Falling prices signal the engine is dying. Who really pays tariffs? But the foreign country pays nothing. You do. An American company importing Chinese steel pays the extra tariff tax at the border. The Chinese supplier still gets their full price. The American company then raises prices on finished goods to cover the cost. That extra charge passes down the chain until it reaches the final buyer, you. Tariffs are taxes on imports, and taxes always end up with the consumer. The cost quietly shows up in your shopping cart. Why can't anyone afford a house anymore? 50 years ago, one income could buy a home. Today, two incomes barely qualify for a mortgage. Housing prices exploded while wages grew slowly, creating a massive gap. Supply is restricted by zoning laws, environmental rules, and local opposition. Fewer homes are built while population grows, driving prices higher. Investors and corporations now treat houses as assets to rent or flip, not just shelter. When Wall Street buys homes like stocks, ordinary buyers get priced out. Low interest rates encouraged bigger loans, which pushed prices even higher. Millennials and Gen Z now face decades of saving just for a down payment. Homes stopped being places to build lives and became portfolio assets. Trading versus investing. Trading is a short sprint, buying and selling quickly to profit from price swings, news, or momentum. It requires constant attention and nerves of steel. Most traders lose money because timing the market is extremely difficult. Investing is a marathon. You buy quality assets and hold them for years or decades, focusing on long-term growth, earnings, and business strength. When markets crash, investors wait patiently because history shows recovery. Compound interest does the heavy work over time. Warren Buffett built his fortune by holding great companies for 30 to 40 years. Trading bets on the next move. Investing bets on the future. Choose based on your personality and patience, not just the dream of quick riches. How the rich use debt to get richer. For average people, debt is a burden. High-interest credit cards and loans that drag you down. For the wealthy, debt is a powerful tool. Suppose you own $10 million in stock. Selling it triggers capital gains tax. Instead, you borrow against it as collateral. Banks offer low rates because you're a safe borrower. You get cash without selling, pay no immediate tax, and still own the appreciating asset. If your investments grow 10% yearly, while the loan costs only 3%, you profit 7% by borrowing. The rich constantly leverage assets this way to fund lifestyles, new investments, and growth while minimizing taxes. Average people can't access these cheap loans. For them, debt means high rates and struggle. The system rewards existing wealth, letting the rich borrow their way to more while others fight to stay afloat. How money laundering works. Money laundering turns dirty illegal cash into clean-looking money. Criminals can't simply deposit millions without raising red flags. They need a believable story for the money's origin. The process has 3 stages. 1. Placement. Getting cash into the system through small deposits or buying luxury goods. 2. Layering. Moving money through complex transfers, shell companies, and offshore accounts to hide the source. 3. Integration. investing in legitimate businesses like restaurants or real estate, mixing dirty money with real revenue so it appears as normal profit. They even pay taxes on it. Laundering works because the financial system handles millions of normal-looking transactions daily. Hide illegal cash in that noise, and the crime disappears. Laundering doesn't hide the money. It hides the crime.